Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. In today's episode, we're going to be looking at another one of your portfolios, and it's going to give us an opportunity to do two really important things. One is see how a professional investment advisor builds a portfolio. The person that sent in this portfolio to us, his name is Alex, uses an investment advisor, and he's questioning whether he should keep doing that. But we're going to get to look at the portfolio an investment advisor put together for Alex, and then we're going to get a chance to model the fee that goes along with it. Because remember, investment advisors aren't free. Most of them charge you a percentage of the assets they manage for you. The technical term is AUM, or assets under management. 1% is sort of industry standard. There are plenty that charge much more than that. And in Alex's case, he's being charged a little less, 0.75%. So 75 basis points or 3/4 of 1%. And we're going to be able to look at the impact that will have in a portfolio. And it's very easy to do in Personal Capital. And so we're going to have a chance to do that as well. So let's get right to it. And by the way, if you'd like me to look at your portfolio, you can either email me, and if you want to contact me, just go to robberger.com. That's how you can do that. Or you can just leave a comment below the video. All I need are the ticker symbols and the percentages that you have invested in each. I don't need your balances. I don't need to know how much money you have. I don't need to know your birth date. I don't need to know anything personal at all. Now, keep in mind, I'm not an investment advisor. I'm just a guy on YouTube with a microphone and a camera, and in sore need of a haircut now that I look at myself. Anyway, I do take this very seriously, and I have been investing for almost 30 years. And I've studied it a lot, but I'm not your investment advisor. If you want someone to help with your specific set of circumstances, you can always hire an investment advisor. I would recommend one that charges you on an hourly basis, not on a percentage of assets under management. But having said all of that, let's get right to it. Let me first read to you the email that I received from Alex. He says, I've subscribed to your channel and I'm a fan of how you analyze portfolios using advanced tools like Personal Capital. And he gives me his portfolio, which we'll talk about in a minute. He says, I'm being charged 75 basis points for management fees on this actively managed portfolio, although I'm learning that it's way better to go with passive investment using index funds. He also pointed out that it's a taxable account, and Alex wants to retire in about 15 years. So with that, let me show you the investments. And based on his email, I expected these to be actively managed mutual funds, and they're not. They're basically ETFs, index ETFs, that actually have, in and of themselves, a very low expense ratio, as we'll see. But keep in mind that the expense ratios don't account for the 75 basis points that his investment advisor is charging. That's separate. We'll look at that in a minute. So let's take a look at his investment. So what I've done, this is Portfolio Visualizer. This is a tool that I use frequently on this channel. For this, we're going to assume a $1,000 starting point. That's not Alex's balance, but that's what we're going to assume for now. A contribution of $500 a month, indexed for inflation, rebalanced annually. And here are all of the funds. So let's just walk through them briefly. So VOO, VOO, that's of course the S&P 500 index fund. We know that one very well. The IEFA is basically a large cap fund that invests in companies headquartered outside the United States. So that's just international companies. IWR is a mid-cap fund, and I actually pulled that up on Morningstar. Let me just show you. Here it is, IWR. It's an iShares fund. It's you can see, I call this the tic-tac-toe box, but that's not really what it is. It's the Morningstar style box. And the columns represent small companies, mid-sized companies, and large companies. Columns are value on one side, growth on the other, and then a blend of the two, sometimes called core, in the middle. And we can see this fund is pretty much, that's really, I think, where you want to start when you're playing tic-tac-toe, I think, right? You want to put the X in the middle, I think. Well, in any event, that's where this fund is. That's all perfectly fine. And by the way, we come back to the quote page. We can see it's, I think, 19 basis points. Yeah, right here, 0.19%. So that's good. All right, we've got IEMG, which is just an emerging market fund. We've talked about those. I use VMAX, which is VEMAX. That's just the ticker symbol for Vanguard's emerging market fund, but iShares is a perfectly good choice. And then we got MUB. What's MUB? Well, it's a bond fund, but specifically it's a muni bond fund. And this is something important to keep in mind. Municipal bond funds tend to pay less in interest than other comparable funds or bond funds with similar duration of the bonds. I won't go into duration, but the difference is they have tax breaks. No federal income tax on the interest. You may not pay state income tax depending on where you live and the bonds in the fund. And for that reason, you want to keep them out of a retirement account. They're best suited for a taxable account, and this is a taxable account, so that's great. The one question, Alex, I would ask is, what's your tax bracket? How valuable is it that you don't have to pay taxes on the interest in this fund? Munis can be great if you're in the top tax brackets, and that's particularly true if you can save on state income tax and you live in a state like New York or California where you're really getting taken to the cleaner. So, if you're in a low tax bracket or even a middle tax bracket, a question I would have for your investment advisor is, why am I in this muni fund given that my tax bracket's pretty low? On the other hand, maybe you're making $1 trillion a year and you need the tax break. So that's just a question that I would have. But a muni, if depending on how you answer all those questions, a muni fund, it can be a perfectly good way to get some bond exposure. HYG, let's talk about this one for just a moment. This is an important fund in this portfolio, and here it is. So this is a bond fund that invests in high yield corporate bonds. Now you think that's good, right? I mean, who doesn't want high yield? Who wants to invest in a low yield bond fund, right? Well, keep in mind that there's another name for a high yield bond fund or high yield bonds, and it's junk bonds. Now, I'm not a big fan of the term junk bonds because they're not really junk. It can be perfectly appropriate to have some of your portfolio in a high yield bond fund, so long as you kind of know what you're getting into. The idea is this fund will buy bonds issued by corporations that have below investment grade ratings from Moody's and S&P and so on. These aren't necessarily companies that are like going to go bankrupt tomorrow, but there is a greater risk that they could default on the bond, which is a fancy way of saying not pay the interest when it's due or the principal when the term of the bond matures. And we shouldn't just brush that aside and say, well, that's probably not going to happen. They do have higher default rates than, say, investment grade corporate bond funds or, of course, U.S. government bond funds. Now, if we look at the portfolio in this for this particular fund, we can see right down here. So basically, BB and up, so BB, A, AA, AAA, those are all investment grade. When you get below BBB, triple B, down here to double B, B, below B, you're talking junk bonds or high yield. And that's where, you can see here, that's where this fund is sitting. Now, because of that, it is going to get a higher yield, right? I mean, its 12-month yield is 4.56%, and it very well may be that that's why the advisor has Alex in this fund, because if you're going to use a U.S. government bond fund, you're not going to be making hardly any yield at all. So I get it. And I'm not here to say that that's a bad decision. You just have to appreciate that there's no free lunch. You're paying for this one way or another with the increased risks of default. Now, when I say default, I don't mean that like this fund is going to go belly up. But what I do mean is individual bonds in this fund, could end up defaulting. For me, I tend to view the bond portion of my portfolio I'm not seeking growth from the bond portion of my portfolio. I'm seeking stability. So for me, I tend to stick with U.S. government bonds. Now, there were times when I invested in high yield. I thought, well, why not? Why not get more yield? More yield's better than less yield. I don't know. I've come to change that view. Again, I'm not here to say that high yield is wrong. Just so you know what the risks are and how those sorts of funds work. All right. Going back to Portfolio Visualizer, this SCHH it's a REIT, only 3%. So that's a question. It's like it almost has no effect on the portfolio at that point. So I'm not sure what the thinking is on 3%, but certainly I don't view this as a mistake per se. Just I guess a question I would have. This is just cash, and Cash X is just how Portfolio Visualizer, when you have cash, that's the ticker they want you to use. The question I have here, and by the way, you can ignore the three below here. They'll come and play in a minute. They're not part of Alex's portfolio. The question I have on the cash is, you're paying the advisor 75 basis points. Why have 6% of it in cash? you can just open up your own savings account, right? And a high yield, savings account at an online bank or whatever, and put that money in cash yourself. I'm not sure why you need to have your investment advisor do that, where he's taken 75 basis points of it. So you're actually losing money, because there ain't no way you're getting 75 basis points on cash right now. At least I can't imagine you are. And even if you are, at that point, you'd just be breaking even. So that's a big question. Why 6% in cash? All right, so having walked through each of the investments in Alex's portfolio, we're going to analyze it. And this goes back to 2008. Now, one word about that. Not all of the funds that Alex is invested in have data in Portfolio Visualizer going all the way back this far. Because I've paid for the paid version of Portfolio Visualizer, I can substitute asset classes for specific ETFs. So for example, for the emerging market ETF, I've programmed my version of Portfolio Visualizer to use, when data for his ETF runs out, use the emerging market asset class that Portfolio Visualizer offers. And I've gotten it to go all the way back to 2008. The limit right now is the Muni Bond Fund. I could have probably tinkered with it more and gone back even further, but I thought this was good enough. And you can see, it's done perfectly fine. Standard deviation around 14, compound annual growth rate of 25%. Now keep in mind, that is influenced by the fact that we're adding $500 a month. Again, I like to show you this. If we didn't add that, we took it out. Whoops, wrong one. Here we go, none. If we took that out and we just started with a lump sum 10,000, the compound annual growth rate comes way, way down, right? But it's because of that $500 invested each month that changes the compound annual growth rate. Anytime you're either contributing to a portfolio over time or taking money out, it's going to change the compound annual growth rate as compared to just starting with a lump sum. Now, the thing I want to show Alex, and I guess everyone watching, is I want to compare this to the Boglehead 3-fund portfolio. That's where these 3 assets come in. These are Vanguard funds. And the asset allocation between stocks and bonds is nearly identical to Alex. And we've talked about the 3-fund portfolio. And if we analyze it, and this again with just the lump sum of 10,000, they basically perform about the same. Actually, the 3-fund portfolio outperforms a little bit. I don't know that I would call that statistically significant, but I didn't do any sort of statistical analysis, but I would say they're reasonably close. Although the standard deviation on the Boglehead 3-fund portfolio is lower. I kind of wonder if that's not maybe the high yield fund in there. I'm not sure. But the standard deviation is a little lower. And if we add back in the monthly cash flows and analyze it, we're going to basically get the same result. I mean, the numbers go up, of course, because we're contributing $500 a month, but these are pretty close. The reason I like to compare a portfolio to the 3-fund portfolio is the simplicity. And by the way, Alex's portfolio is not complex. I mean, it would be easy to implement and manage on your own. It certainly would be incredibly easy at M1 Finance, where you can just rebalance with a click of a button. But honestly, it wouldn't be that difficult at Vanguard or Fidelity or any other broker. At the same time, the question I would have for the investment advisor is, why not just a 3-fund portfolio? It's simple, much easier to manage. We don't know what the future is going to look like, but at least based on what we've got here, they kind of seem to perform about the same. And in fact, if we looked at the exposure, which is this tab right here, there are some differences, but when you look, you've got asset classes over here on the left, Alex's portfolio here, and then the Boglehead 3-fund portfolio. There are differences here and there, but by and large, they look pretty similar. So, if you're hiring an investment advisor, I suppose you could say, well, what do I care about the complexity? The investment advisor has to deal with it. But simplicity is more, to me, it's about more than just the complexity of dealing with the portfolio. As important as that is, particularly when you're managing your own investments with things like rebalancing, very important. But I find that the fewer investments you have, the easier it just is to understand your portfolio and to know exactly what you're invested in. Again, all in all, I think the portfolio that Alex has, is created by his investment advisor, is reasonable. Again, I have some questions about the Muni Bond Fund. I have some questions about the high yield, but I kind of get it in this investment interest rate environment. Definitely some questions about 6% in cash. I don't know why you'd pay someone 75 basis points to hold 6% in cash. That I don't understand. But with those questions, by and large, I think it's a reasonable portfolio. Now, having said all of that, we got to look at the fees. That's probably the most important thing here. So let me pull up Personal Capital. Let me put it back on the screen for you. Here it is. And again, this is a demo account that I created for these sorts of videos. And we've got Alex's portfolio in here. Let me actually show it to you. And I've got to eliminate all of the other accounts. Now, what I've done, and this is what I do with each portfolio I analyze in Personal Capital, is I just created $1 million portfolio. So you got to keep that in mind. That's not Alex's number. Every portfolio I analyze in Personal Capital is going to have $1 million valuation, but the allocations percentages are all the same. And the first thing I want to look at before we get to the investment fees is just the allocation. And again, by and large, I think it seems pretty reasonable. About 20% in cash and bonds. Again, I think it's too, I don't understand the cash when you're paying the advisor, but 20%, 21% cash and bonds roughly, more or less. And then 80% in stocks. And so that, seems perfectly reasonable to me. If we drill down into the US stocks, seems like it's got a nice allocation across small, mid, and large cap. Definitely tilted towards growth. At least at the large cap level, that might be a question, but again, we're nitpicking at this point. But we have to get to fees, and here's how we do that in Personal Capital. We go to the Planning tab, and then we go to Retirement Fee Analyzer, and then I've got to make sure I'm only looking at Alex's account. There it is. And I'm going to make an adjustment here. There we go. So this is Alex's account, and we can see 14 basis points. So that's reasonable. I mean, I'm a big believer in lower is better. I prefer 5, so I would work on trying to get that lower. But 14 basis points more than reasonable. Now, the thing I want to show you is how do we model the 75 basis points being charged by Alex's investment advisor, and we can do it down here. So here we set the annual contributions. We could set it to 0, right? And we've got an annual employer match. We're going to leave that at 0 for a moment. And that's important because for Alex, this is a taxable account, so there's no employer match. But I point this out, if you did have an employer match, you could put that in here. It goes up to $19,500. Does anyone have an employer match for that amount? I don't know. If you do, I'd like to work for your employer. You can set the assumed annual growth. Right now it's at 7.5%. And it's here, this last glider, I don't know, whatever you call it, where we can add in the investment advisor fees. So where we are now again, keep in mind this is $1 million portfolio. The age assumption is 41. You can change that in a portfolio visualizer. You go up and do settings. It's very easy. It's assuming we retire at 65. And if we don't contribute anything more, there's no employer match. We have a 7.5% growth and no investment advisor fees. We're going to pay, even with just 14 basis points, $180,000. And if that shocks you, then I've accomplished my mission in this video. It should shock you. The numbers get huge. And you may say, well, Rob, that's $1 million portfolio and I've only got 100 grand. Okay, so it's going to be what, 18 grand? It's going to be a big number. And here's the thing, when investment fees come out, that's just less that can compound. And our minds don't intuitively appreciate the power of compounding. It can work in our advantage, it can work to our disadvantage. With investment fees, it works to our disadvantage. Now, let's imagine we actually are contributing to this portfolio, and we'll assume $500 a month. So that'd be $6,000 a year. See, there it is. So this goes up just a little, from 180 to 189. Still money, but not a huge jump. But what happens when we jack it up to 75 basis points for the investment advisor fee? So we're at 189. I'm going to give you a second to guess. What do you think it's going to be? It's going to go up to 200, 250, a quadrillion. You got your number? All right, here we go. 75 basis points. Let's see if I can zero it in, right? Oop. Almost there. $1,083,055. Yeah, that's a big honking number. Yeah, investment fees matter. Now, again, this is $1 million portfolio starting balance. I get it. You may be much lower than that, but I guarantee you get a hold of Personal Capital, you link your accounts, and you run the tool, it's going to be shocking. Here's the thing. The asset under management model is it should be a dying model. There's no reason to pay someone 75 basis points a year to stick your money in 6 mutual funds or ETFs. There's just so many tools today that make it easier. The way they sell their assets under management service is what they say is, well, I'm giving you other advice. I'm giving you a financial plan. I'm helping you figure out life insurance. I'm helping you figure out when you can retire. All good stuff. And they may be great at it. Pay them hourly, right? Why? Imagine if you went to someone and said, can you help me figure out how much life insurance I should have? I will. And it's only going to cost you 75 basis points, 0.75% of all the money you have for the rest of your life. It's just idiotic. So that's my personal view on investment fees. I hope I'm, not beating around the bush here. I'm being very clear. Friends don't let friends pay high investment fees. It's just really, really, really bad for your wealth. If you want help, you can use a robo-advisor like Betterment or Wealthfront. You can use M1 Finance, which makes rebalancing really easy. You can use Vanguard with 50,000 or more. They'll provide the same service. It's still not cheap. 30 basis points. Let's model it. Let's model this, Mr. Vanguard. Still a lot of money. Yeah, but it's a lot less than 75 basis points. And then there are those that just charge by the hour. And that's what I would recommend. So, Alex, overall, I think the portfolio is reasonable. I have definitely some questions as I've outlined them in this video. But as you already suspected, the big issue is the 75 basis points. Now, yes, I've modeled it with a starting portfolio balance of $1 million. And I know yours is different than that. But I think if anyone watching that wants to know how fees are going to affect their portfolio, give Personal Capital a try. It's totally free to use, and you'll see for yourself. And by the way, it automatically pulls in the expense ratios of the ETFs or mutual funds that you're investing in. It gets that data for you automatically. It gets that factored in. And then as you saw today, if you are paying an investment advisor, you can model that very easily as well. Listen, if you have any questions at all, leave them in the comments below. I'll help you out any way I can. And if you use an investment advisor and want to share the investments he or she has you in and the percentages and the fee they're charging you, I'd like that a lot. I'd like to look at more of these because this, I think, is maybe the most important type of video I can put out there when it comes to investing. Well, listen, I hope you have a great day. And until next time, remember, the best thing money can buy is financial freedom.